You could be taxed on money that you haven't even made yet. And this is not theory, this is being proposed in Australia right now. The government is targeting unrealized capital gains inside of superannuation accounts. But many politicians and senior officials are exempt from the very same rule that they're proposing to introduce. In this video, we'll talk about how it works, who's impacted, why the exemptions exist, and what you should be thinking about. And stick around till later, because even though you might not be at a $3 million balance today, this could very well impact you later on. My name's Marel. I'm a former business consultant turned insurance broker, and on this channel, I help small businesses grow smart, stay protected, and avoid costly mistakes. This channel simplifies complex financial topics so that you can run your business with confidence. So what's actually changing? Well, the Labor government is proposing a 15% tax on unrealized gains inside super accounts on balances over $3 million. What happens now is you're taxed only when you sell assets, right? That's taking your paper gain to a realized gain. This is changing the game here because what the Labor government is proposing is essentially taxing you before you've sold anything. Specifically, if your assets grow in value on paper, then you'll be taxed on that gain. The big thing here is that whether you have the cash or not, doesn't matter. You're still going to be taxed on that gain. Let's run through an example here. Say this tax bill passes and you've got a property inside your SMSF, that's your self-managed super fund. You've purchased that for $2 million. It's now gone up in value by $1.5 million. So it's worth 3.5 over that $3 million threshold. Well, you're going to be taxed on that gain. That gain between $2 million and $3.5 million is $1.5 million.
Now, here's exactly what happens. You're $500,000 over the $3 million threshold. So only about 14% of your super is above the limit. This means that only about 14% of that $1.5 million gain is taxable, which is about $214,000 under this new rule. That extra 15% tax is around $32,000. Even though you haven't sold the property or received any cash, you'd owe roughly around $32,000 in tax.
Why business owners are worried about this? Well, many business owners are worried because they use their SMSF to hold property or private investments. Now, the assets in here don't always throw off big cash flow. That is, they're bought strategically for the capital gain. Taxing these paper gains runs the risk of the business owners not having the cash to foot the tax bill if it comes up. The issue here for business owners is they might look at things that they otherwise wouldn't have considered. They might be forced to sell assets, they might have to restructure or look for outside funding just to address the tax bill. The other issue here is that asset values fluctuate. You might be taxed on paper gains that disappear later on. Who's affected by this and the inflation trap? Well, the government is saying that initially this is only impacting around 80,000 people. But the kicker here is that the $3 million cap isn't indexed for inflation. Now, they say the inflation number is anywhere between 2 to 3%, but in reality, it's been higher than that in recent years. We're talking north of 10%. And over time, many Australians, including small business owners, could cross that threshold. Long-term property growth, the value of businesses going up, or just simple inflation could push many Australians into this tax bracket 10, 20, 30 years down the track. Let's talk about the exemption controversy. Politicians, judges, senior public officials, they're largely exempt due to the defined benefit pensions. So what this means is they don't get valued in the same way that SMSFs do. Business owners are taxed on paper gains, while public sector officials, they avoid the same rules. This here raises major fairness concern because essentially it's one rule for them and another for everyone else. And critics, they're calling this a wealth tax by stealth. For many, there's the issue about the money, that's one part, but the other part is the unequal treatment of everyone else. For many, the tax and the money is one large portion of this, but that's not the only issue. The other issue here is the principle of unfair and unequal treatment for everyone else. The bigger long-term concern. The other thing to consider here is that should this tax bill pass, this sets a dangerous precedent for other tax laws in the future. Should this proposed tax bill pass, it sets a dangerous precedent for future taxes and how they could be structured. If they can tax unrealized gains inside of super, then what stops them from expanding this to other areas? Think about this for a second. Could this one day apply to business valuations, property portfolios, private businesses? Even though that's not proposed today, once that line is crossed, future governments could potentially build on this. This essentially creates uncertainty. uncertainty. Uncertainty for long-term investing, for business growth, and for wealth creation. So what should business owners do now? Well, this proposal hasn't been passed into law yet. So for now, you don't need to take any action, but you do need to stay informed. Be aware of how policies like this could impact you down the track if they do go through. One thing that you can start doing is educating yourself on asset structures beyond your super. What I suggest is speaking with a financial advisor or an accountant, not to make any changes right now, but to understand what options exist. Knowledge here is power. Understanding that this proposed tax bill might come into effect, and also speaking with professional advisors around you to understand what levers you can pull down the track should this come into law. And the knowledge here should help you be well-rounded and assist in making better long-term decisions. If this or similar policies pass, then being educated now gives you greater flexibility instead of scrambling later on. Whether you're above or below that $3 million, this is a reminder of how fast policies can shift. Build in flexibility and guardrails when you're planning. Don't assume that the rules today are permanent. Stay informed and stay protected. Like, subscribe, and comment down below what you think on this tax. And I'll keep breaking down these changes so you can keep on growing your business without getting blindsided.